Welcome to Iron Financial. We're not here to read you the glossy press releases. No, we're here to forge a stronger portfolio by putting the market's biggest names under some serious pressure. Today, Wipro's third quarter earnings are on the anvil. Now the headlines, they look pretty good, but our job is to see if the metal is truly sound or if it's riddled with impurities. Let's get to work.
So let's talk about Wipro. This isn't just some tech company. It's one of the absolute pillars of the global IT services industry. You're talking about a company with over 240,000 employees. So when a behemoth of this scale speaks, you better believe the entire tech sector, and really, the whole global economy, stops and listens. Their performance is a bellwether. It's a signal flare for corporate tech spending, for digital transformation trends. So yeah, when their numbers drop, you have to start asking some very hard questions.
You know, if you just skim the surface, you'll see a story of really impressive operational excellence. We're talking strong margins, absolutely incredible cash flow. But we don't do surface-level analysis here.
Yeah, and that's the whole point, isn't it? The market is a graveyard of companies that looked completely invincible right before they cracked wide open. Our job, our entire purpose here, is to take a hammer to the weak points. We need to see what management is shining a spotlight on versus what they might be quietly hoping you'll just ignore. So is this a fortress built on solid granite, or is it a beautiful facade with a foundation that's turning to sand? That's the billion-dollar question we're going to answer today.
Okay, let's get into it. And to be fair, we have to start with Wipro's version of events, the numbers they put front and center. And if you just look at those, the story they're telling is one of formidable, almost military-grade operational strength and discipline. They are absolutely controlling their costs and executing with incredible precision.
And this number right here just perfectly illustrates that point. An IT services operating margin of 17.6%, this is the core engine of their profitability. It's everything. And what's really crucial to understand here is the trend. It expanded 0.9% sequentially, quarter over quarter, and 0.1% from this exact time last year. You have to understand, in an economic environment where everyone is screaming about cost pressures and inflation, expanding your margins like this, that is some serious heavy lifting. It's a real testament to their execution. And look, you don't have to take my word for it. The CFO herself, Aparna Iyer, called it their best margin performance in last few years. I mean, that is a powerful statement. It tells you that management's focus has been laser sharp on profitability, on squeezing every last drop of efficiency out of their operations. This is the narrative they want you, the investor, to focus on.
A powerful statement, for sure, and a very convenient one. It's always nice to talk about how well you're managing costs when maybe you don't have a whole lot else to brag about. But we'll get to that. For now, yeah, let's keep going with their highlight reel.
Precisely. And this right here is the other main pillar of their official story, a simply staggering 135.4% operating cash flow conversion. Let me break that down for you. For every single dollar of net income they report on paper, they are generating over $1.35 in cold, hard cash from their actual operations. This is not some accounting trick. This is the lifeblood of a company. It means they have immense financial flexibility, they can invest, they can return capital to shareholders, they can weather just about any economic storm that comes their way. It is an undeniably incredibly strong number. It's a cash-generating fortress.
A fortress. Okay, I like that metaphor. But you know, even the strongest fortress in the world is pretty useless if it's not expanding its territory. All this talk of margins and cash flow, it's great, but it's what we call below-the-line analysis. I want to talk about the top line. I want to talk about growth. Because let's be blunt, a company that isn't growing is, by definition, shrinking relative to the rest of the economy. So, analyst, let's put the real revenue numbers up on the screen and find that first crack.
Okay, so here's where things get really interesting. This slide tells a completely different story if you bother to look past the headlines. You see, management is taking a victory lap over the sequential growth, the quarter-over-quarter numbers. They're positive, right? 1.2% reported, 1.4% in constant currency. Okay, fine. But now look at the right side of the screen. The year-over-year constant currency number. That is the true measure of health. It strips out all the noise from currency fluctuations, like a strong dollar making foreign revenue look smaller, and it tells you how the underlying business is actually doing compared to a year ago. And what does it say? It's negative, minus 1.2%. So, analyst, explain this to me. How can you be proud of a structure that is physically smaller than it was last year? You are absolutely right to point that out. It is without a doubt the most significant structural weakness in this entire report. Yes, the sequential growth shows they managed to stop the bleeding, at least in the short term. Maybe they pulled some deals forward from next quarter to make the number look okay. But that year-over-year figure, it's undeniable. The growth engine hasn't just stalled, it's actually in reverse. In a stable currency environment, they are generating less business than they were a year ago. So while they're running the existing machine more efficiently, that's the whole margin story, they are not adding any new horsepower. This is the first, and I think, the most critical crack in the entire foundation. Exactly. And that sputtering engine leads me directly to my next big question. If this machine is running so efficiently, like those beautiful margin numbers suggest, then where are the profits? You can't just cut your way to prosperity forever. At some point, you need actual growth to fuel the bottom line. So, let's dig into the net income. Let's solve this little profit puzzle, shall we?
And there it is, in black and white, a 7% year-over-year decline in reported net income. I mean, this is a direct contradiction. How on earth does a company with its best margin performance see its profits fall by 7%? The math just doesn't add up. It feels like they're telling us the walls are stronger than ever, but the roof is caving in. So analyst, what is the official explanation for this? Because from where I'm sitting, this looks really bad.
Okay, so this is where it gets a little more complex, and this is where management presents its counterargument. They direct our attention to something called a non-GAAP measure, adjusted net income. Now, the argument they're making is that the official reported GAAP number was hit by a very significant one-time charge, specifically a charge of over 3 billion rupees tied to the implementation of a new labor code. So, their position is, hey, this is a one-off event, it's an anomaly, and it doesn't reflect the core ongoing profitability of our business. By adding this cost back in, they claim they're showing a truer picture of their real earnings power.
Oh, I see. So let me get this straight. We go from a pretty ugly 7% decline to basically flat, a 0.3% increase. And all we had to do was just, ignore a 3 billion rupee cost. But here's the fundamental problem with that kind of logic. That was a real cost. That's real money that the company had to account for. This whole game of adjusting earnings is a very slippery slope. It's like finding a big crack in your foundation and just painting over it. The crack is still there. Are we, as serious investors, really supposed to believe the earnings quality is solid when we have to start ignoring multi-billion rupee expenses just to make the numbers look good? It makes me wonder what else they might adjust away next quarter.
Which brings us to the most important question of all. Honestly, forget the past quarter. Investing is about the future. So where is the new growth going to come from? If the current engine is sputtering and backfiring, what's the plan to build a new one? Let's look at the forward-looking indicators. I want to see the metrics that tell us if the pipeline for new business is full or if it's running on empty. Well, management's answer to your question is unequivocal. It's artificial intelligence. Here's a quote directly from the CEO, Srini Pallia. He is betting the entire farm on AI. He's saying their proprietary Wipro intelligence platform is the key differentiator, that it's already out there winning them deals. This is the story they're selling to the market, that Wipro is at the forefront of the AI revolution, and that this is the technology that will reignite their growth engine. This is the blueprint for the rebuild.
A beautiful story. It's inspiring, really. But here at Iron Financial, we check the receipts. All this talk about AI wins sounds fantastic, but the single most important forward-looking metric is large deal bookings. These are the mega contracts, the deals over $30 million that are supposed to fuel growth for years to come. And what does the hard data say? It says large deal bookings are down 8.4% year over year. That's not a sputtering engine. That's an engine that's being actively dismantled. How can you claim you're winning the future when you're losing the biggest deals today?
And this isn't just a one-quarter anomaly. The skeptic is absolutely right to be concerned. As we look at this chart of total bookings over time, the story it tells is deeply, deeply worrying. We are seeing a clear, unmistakable downward trend, a steady erosion of future revenue. It went from a high point of nearly $4.7 billion in Q3 of last fiscal year, and it has fallen consistently, quarter after quarter, down to just $3.3 billion this quarter. This isn't a dip, it's a decline. The pipeline of new business is shrinking. The amount of new work they're signing is getting smaller and smaller. This trend is the single biggest threat to Wipro's future, and it directly contradicts all the optimistic rhetoric we're hearing about AI-driven growth. The data simply shows the rebuild isn't happening yet. Okay, so the growth story is weak. The bookings are trending in the wrong direction. The picture looks pretty bleak. I get it. But before we condemn the entire structure, we have to look at its foundation. Can the fortress withstand a siege? Even with a weak growth engine, a company can survive and even thrive if its core financial structure is sound. So let's stress test the balance sheet.
Now, what is so interesting about this slide is the sheer boring stability it demonstrates. While the growth story is all over the place, the foundation is solid rock. Let's walk through this slowly. First, total equity, the net worth of the company. It's increased significantly, from 830 billion to nearly 900 billion rupees. That's a very strong sign. Next, total assets are up, which means the company's resource base is actually expanding. And crucially, look at the debt. Total loans and borrowings have remained stable. They're not piling on leverage just to survive. And the reason they don't have to is that final point. They are sitting on a massive pile of 119 billion rupees in cash and equivalents. This is a company that is built to last. It can afford to have a few bad quarters on the growth front because the underlying structure is just incredibly strong.
And this brings us full circle, right back to their greatest strength, the cash generation. This isn't just a number on a page. It is the ultimate load-bearing pillar of the entire enterprise. That 135.4% conversion rate means the business is just gushing cash. This cash is what reinforces that strong balance sheet, it's what funds the dividends, it's what gives them the optionality to make acquisitions or invest in R&D to try and fix that broken growth engine. So while the growth picture is a major concern, this financial firepower absolutely cannot be ignored. It's their biggest and best defense.
All right, so we've laid out all the evidence. We have the pristine operational metrics on one side of the scale and the alarming decay in growth on the other. It's a strong foundation supporting a sputtering engine. So let's bring it all together. Let's put all the pieces on the table and deliver the final verdict. For the investor watching this right now, is Wipro an opportunity to buy a solid, cash-rich company on the cheap, or is it a classic value trap?
This slide right here sums up the entire conflict. On the left side, you have the solid pillars. Best-in-class margins, massive cash flow, a rock-solid balance sheet, and incredible operational discipline. This is the defensive case for Wipro. It is a well-managed, profitable, cash-generating machine. But on the right, you have deep structural cracks that you simply cannot ignore. Negative revenue growth, falling profits, even if you try to adjust them away. And most importantly, a clear downward trend in new business bookings. The growth engine is failing. So the debate really comes down to this. Do you bet on the strong foundation and just hope they can fix the engine? Or do you assume that the cracks in that engine will eventually crumble the whole foundation?
And that is the final crucial point. The verdict from Iron Financial is that Wipro is a contradiction. It is a financial fortress with a failing growth engine. The company's not an immediate collapse risk. That balance sheet is just too strong for that. But it is also emphatically not a growth story. The data simply does not support it. So we leave you with this question. Is management's priority to defend the fortress, meaning focus on margins, cash flow, and shareholder returns, or is it to take bold and maybe risky steps to rebuild the growth engine? The path they choose will define Wipro for the next decade. And as an investor, your decision to buy or sell hinges entirely on your answer to that question. Thank you for joining us at Iron Financial.
I am not a financial advisor. This is for educational and entertainment purposes. Do your own research.